Hey, good morning, options traders, and happy Monday, everyone. And yes, it has been a long time, and I know I've said this the last several videos, but I have been incredibly busy. I'm going to try to start getting back on track. But what I thought I could do in the meantime is to maybe recycle some of the older ones that people might have forgotten about. So at least we can get some videos posted on the website. So I'll try to do that as well. But today we do have a brand new video, and I thought this would be helpful for people to talk about the power of gamma. And the reason I thought this was a good one is that whenever I teach the Greeks, people say, okay, yeah, that's interesting. I know how these Greeks work, but how do you use them? What's the real practical point? Well, good question. There's a very big practical point, and when you understand how to make the Greeks for you, that's when you'll see the power of understanding the Greeks. So let's take a look at the power of gamma. And as always, before we get started, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So let's start with a quick definition of gamma. Remember what gamma is. It shows by how much your delta will change for a $1 change in the stock's price. Now, the caveat to that, which is true for all of the Greeks, whenever we say it's a change in, let's say, a $1 change or for 1 day's passage of time with theta, it's really too big of a change. And the same is true here for gamma. So when we talk about changes in gamma and how it's going to affect delta, that really a $1 change is too big. So if you run this in a pricing model, you're going to see that you're going to be off by just a tiny bit. But that's okay. It's just because we're really stretching the definition a little bit just to make it easier to understand. So whenever you have long options, that is options you have purchased, you will have positive gamma. That's important. So whether you're buying a call or a put, you have positive gamma. Now remember, for delta, it's opposite, and this is what throws a lot of new traders. The call options have positive delta, the put options have negative delta, but they both have positive gamma. And there's a big benefit in having gamma, and that's one of the reasons that you must buy an option. So what does positive gamma mean? What it means is that you are going to add deltas as the stock price rises, and you will subtract deltas as the stock price falls. So the easy way to think about it is that stock up, and stock down, delta down. You see how it's moving in the same direction as the stock. And that's another way to understand what positive gamma means. It's mirroring the movement of the stock. On the other hand, if you sell an option, you have a short option and therefore you have negative gamma. And so it's just going to be the opposite. There you're going to see stock down, delta up, and stock up, delta down. So I'll show you some little tips and tricks for negative gamma and how you can put those to use. But for today, we're just going to talk about positive gamma. So for example, let's say that we have a stock trading for 100 and the $100 call is trading for 3. We look on our broker's platform and maybe you see a delta of a half or 50 and a gamma of 10 or 0.10. So what does this mean? What it means is that if the stock makes a $1 move right now, so it's going to move from 100 to 101, we should see that delta increase from 50 to 50 plus gamma. It's going to pick up gamma. So the new delta will be 60. Now, as I always mention, whenever you're dealing with the Greeks, it's incredibly important to understand that this is assuming an instantaneous change in the stock's price. You can't look at your broker's platform and say, oh, I've got a gamma of 10, and then 10 seconds before expiration say, well, the stock went up $1. How come my option didn't change by 10? Well, it's because you didn't do an instantaneous change. If you wait too long, you've got theta to contend with, you've got all of these other variables. It's talking about a $1 change right now. So on the flip side, if we have the stock, let's say, falls to 99, you're going to subtract gamma, or in this example, 10. So your delta would be expected to be 0.5 minus 10, or 0.4. So as I showed with the last definitions, stock price up, delta up. It went from 50 to 60. Stock price down, falls to 99. Then the delta goes down. It fell from 50 to 40. Okay, well, that's all very interesting and well and good, but what does it do for you as a trader? Well, again, this is where you have to understand how to put it into effect and how to put it in your corner. And so, one example would be with momentum trading. So, a lot of traders out there like to jump on what they might call a swing trade or a momentum trade. And what they're trying to do here is to buy shares as the stock rises and sell shares as the stock falls. So, a way that you could do this as a stock trader might be, let's say, buy 100 shares, but then buy 10 shares every time the stock goes up, whatever, a dollar, $2, or that it goes up 3 or 4%. You have some kind of a recipe in saying every time the stock does this, I'm going to add a certain number of shares. Or if the stock falls, I'm going to subtract a certain number of shares. So that's a way that you could kind of manually create your own momentum strategy by using stock. The problem is that traders are tempted to sell at the first sign of profit. So they think they're going to get on this momentum strategy, stock goes up, and what do? Bail out of the position. Or the stock comes down, and instead of selling the shares, they say, I'm really kind of reluctant to sell because otherwise I'm going to be locking in a for sure loss. Let me wait and see what the stock does. Or worse yet, let me buy some more shares to average down. So they end up doing the exact opposite of what they intended. Well, this is a good setup where Gamma can come to the rescue. And as we found out, the reason is that Gamma will add deltas as the stock price rises, and it will subtract deltas as the stock price falls. And this is exactly what momentum traders want. So again, let's say that our stock is 100. We've got a $100 call, maybe with 60 days to expiration, that's valued at $5. We look on our broker's platform, we see the delta is a half or delta 50, and the gamma, let's say, is 0.03. Well, one thing you could do is to buy 100 shares. Of course, that's going to cost you $10,000. But what could you do as a momentum trader? Well, we see that the delta is a half. We could buy 2 calls and have delta of 100, which is exactly what you would have as a stock trader. The difference is, as a stock trader, you will always have 100 deltas. It's never going to increase on the way up. And on the downside, it's also going to stay at 100. It's not going to start tapping the brakes, so to speak, and starting to sell shares for you. It's always going to be delta 1. So if we turn around and we buy 2 calls, we have 100 deltas, just like if we bought the shares. The difference is we actually control 200 shares. So as the stock price rises, Gamma is going to start increasing us towards 200, or if the stock price falls, Gamma will automatically start subtracting, and it will start reducing the exposure, which means we will lose less than if we bought 100 shares. So let's compare the 2 graphs. Here we've got in black is our long shares of stock at 100. There's our break even right there at 100. And in red, look at that. Those are the 2 at the money calls. So as the stock price goes up, look what happens. The red curve actually starts pulling away from the black. It's becoming more profitable. Why? Because it's continually adding deltas automatically, whether you want it to or not. It's going to start pushing you towards 200 deltas. But look to the downside. If the stock price falls, it's subtracting deltas for you automatically. Whether you want it to or not, it's going to say, all right, we've got delta 100, pretty soon we're delta 90, 80, 70, and when we get down to delta 0, then the most you can lose in this example is the $10 paid. So we can see that this red line is starting to line up right there at minus 10. But if you held the shares, look at that. Losses could really pile up. Now, as always, yes, this can certainly look like the option strategy can't lose because the red line always sits above the black. But remember, this has 60 days until expiration. This is what's called a current curve. And over time, it's going to start changing as time decay kicks in. So it will slowly start moving from that curve to this one. This is what we're going to see at expiration. So now we do see that there is a difference. So as always, we get a crossover point. In this example, we have 2. But anytime you compare 2 option strategies or options compared to stock, anything, you're going to get at least 1 crossover point. And that's where the 2 strategies cross. And so that means that both strategies produce the same profit or loss at this number. So if the stock is 90 and you held 100 shares, you're going to lose 10. And if you had the 2 calls at 5, you're going to lose 10 at expiration with the stock at 90. But if the stock falls below that, look what happens. Now the benefit of the option is seen. It just levels you off at 10, whereas if you had the shares, you're going to continue taking losses. So we can see that this break even right here is going to be 90 on the downside, and that is found by taking the $100 strike minus the $10 paid. All right, now what about this crossover point up here? Well, up here is 110, and that's found by taking the 100 strike plus the $10 paid, and that gives us the upper crossover point. And so what this means is that if the stock goes to 110 and you bought the shares instead, 100 shares, you would be up 10 points. And if the stock is up here at 110, if you had 2 of the $100 calls, your profit would be 10 bucks. Now, yes, each call is worth 10 bucks, right, or $20 total, but you spent 10. So remember that these graphs are always showing the total profit or loss that happens to you. It's not showing you the options value, because your options would be worth 20 bucks in total here, but because you spent 10, there's a gain. So it's exactly the same as if you owned the 100 shares. However, if the stock is above 110, what happens? Well, now the 2 call options will outperform because you actually have 200 deltas. And that's seen by this red line being much steeper than the black. So as always, anytime you have options, and especially an at-the-money option, you've got a lot of gamma, and it's a race against time. So if the stock happens to be between these 2 crossover points at expiration, yes, the strategy will take a loss. But if the stock is outside of these crossover points, it's going to have some kind of a gain. So as always, anytime you're dealing with options, certainly closer to at-the-money options, you have a lot of gamma, and therefore you have a race against time. And that's really what this whole strategy is about. So you can see at expiration that we definitely need that stock to get moving faster and faster to outperform the stock. However, if your outlook is correct, let's go back to the original curve, you can see that the 2 call options absolutely dominate the stock. So if you're right, especially in the fairly short term, in the next few days or so, it's going to greatly outperform the shares of stock, and you're only going to have a fraction of the money invested. So by using 2 of the call options instead of 100 shares of stock, it's a great way to manage risk and be sure that you keep on track with your strategy if you're trying to be a momentum trader. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.